Good morning. The topic of this morning is going to be understanding options. So with that, we're going to start immediately here. Before we start, we're going to explain something here right quick. I would like people to understand the consequences of losing money and how expensive can it get. So we have made a table that included $1,000, and when you lose $80, you are lost 8%, but it takes 8.7 to recover. To simplify this, it's just like when you have lost $500 out of the 1,000, it actually you have lost 50% of your money, but to recover it, it require 100%. So we're going to make this available in Facebook. You can download it, copy it, and print it for your reference. This is normally the seminar that our third year at the local library. This year, due to the pandemic, we could not make the seminar. So what we're trying to do now is to put this in videos and be able to make it available to the students. This here at the bottom is the new book that I'm publishing. It'll be sometime in August next year, so we'll see how that goes with the publisher. Nothing definite yet. With that, this is my top tip of the day. I keep on saying it and saying it again. The educated trader typically get paid from the trader who had no education, no plan, and trade on emotion. This is very important because sometimes we start losing money and we hate to lose the money, but this is nothing but emotion, and what happens is that we end up losing more. One thing I'm going to explain to you when it comes to options and actually to buying a stock is that on this example, we have a shares of a stock company, whichever that might be, XYZ, that is $100 a share. When we check the accounting systems and equipment that they own, and everything that it belongs to this particular corporation, plus what they owe to somebody else, we arrive at the true value of the stock. This is called the true intrinsic value of the company. Now, what happened is that markets open, people want to buy the stock, so there's a demand to buy stock. So when there are too many buyers, the volume drives the price up. And when there are few buyers, it drives the price of the stock down. This brings us to a situation that the company really worth $100, but there's big demand, price drives up, and it become overbought, maybe $110, $120 in here, like it shows here. So the company, people paying $20 premium more than what the company worth. On the other side of it, if there are too many sellers, the volume also goes up. A lot of buyers, a lot of sellers, and it drives the price down. When there are few buyers, it also drives the price down. So they go hand in hand. Not too many buyers, then the price comes down, trying to entice them to buy it. When there are few sellers, the price goes up. That's because a lot of people don't want to sell the stock, and to get them to sell it, you have to offer them more money. Just plain simple as that. So it's just like an auction. You buy and sell, and in this case, we're selling equities. So the stock could be overbought or oversold. When it's oversold, because nobody want to buy it, the price might go down to 80. So now the company that actually worth $100 is undervalued, it's oversold, and you can buy it at a bargain price of $80, 20% less than what we actually worth, until finally people wake up to that and then, oh, wow, then they start buying, drive the price back up again. This is about options we mentioned earlier. And right here, I'm going to explain to you the risk of trading option, whether you're buying or selling puts or call. The option writer, the guy that sells an option, which is called the option writer, he has the advantage over everybody else. He collects 100% of the money immediately, and then he don't worry about it. And by expiration time, he's off the hook. He owns the stock. He might have it at a much higher price too than what he bought it on the strike of the option. So he makes some extra money on the top of what he's going to collect when the option get called. They call his stock. He sells it, make a profit, plus he keep all the money of the option premium. On the other side, the option buyer, he is at disadvantage because the price of the options are overinflated. They're paying more than what the option really worth. There's a reason for that. We can see it on item number 3. The option is overinflated because it's created by the brokers because they can get more commission. So the way that happens is that when you look at the table from option, you see there the bid, the ask price, you see volatility, implied volatility, and this is, you see the delta and stuff like that on it. So on the implied volatility, you might see 0.57. And what it's telling you is that this particular option could go from the actual price 50% down, or 50% up, or 57% up or down on either direction. Because you got that much volatility that you can go up 50% or go down 50%, it demands a higher premium. So based on the price of the option, the dealer make more commission. Another disadvantage that the buyer have is that option value do not match the gain on the underlying asset. For example, you might have Apple as the stock, and you're going to buy 100 shares, one contract of a call for Apple at $200, and you pay $500 for that. Now, tomorrow, Apple goes up $2, but your option might gain only $1.10 or 90 cents. So here you have it, where you are at disadvantage again because the stock went up $2, but you might get only 90 cents on your option. So it's something to remember that I want you to think about it. And then we have the other part. This is the option have a time value, and that time value decrease eventually to 0 at the expiration date. So when you buy an option, it's not the same as buying the stock. Even so, people tell you, well, you buy an option, 100 shares, you can participate on the movement of the stock without having to spend $20,000 buying Apple 100 shares at $200 a share. However, the one that buys the stock, he can keep the stock forever. But you buy an option and it's for 2 weeks, 3 weeks, or 4 weeks, or maybe a few months. At that time, that option is going to become worthless. It's going to have a 0 value and it don't worth anything. So if the price had not moved in your favor, you're going to lose the entire money. or unless you get out before. So you bought it, you can sell it at any time. So always remember that this is also a picture here that you'll be able to print and download it for your information and understand what I'm talking about. Now let's look at an option, how the price deteriorate, how the price decay as time go by. We don't talking here about the actual stock. This is just about the value and the decay of the value based on 100 days. Let's say that this option is going to cost $550 and it's 90 days, 3 months and a few weeks out before it expires and it becomes worthless, unless it is in the money and it has some premium base that is how much is on the money. But we don't interested in that at this time. What we're interested in is in the option decaying value. So you start here and the time that it takes. So you take over here $550 at the beginning, and by the time that's 25 days had gone by at $75 right here, the option had lost $100, so now it only worth $450. We continue down in here now 45 days or so, close to 45 days, the option had gone down to $350. So now you have lost $200. So we have gone through 50%, close to 50% of the time. Of the 100-day, we're a little over 50%. And the stock only, the option only has lost $200. However, we come over here 30 days later, and at 30 days, that is just for expiration day. So now most of the time is gone. We got over 2 months and 2 weeks into it, and the option now got $250. So it's very close to have a 50% loss. And it's very interesting. By the time we got 5 days now, over here before 5 days, the option now was only $150. Notice that from here down, it kind of come off of the cliff. We've been coming down and this slide, and then on the last week and the last month, this thing really start tapering down. So 5 days away from this, we find 150, but yet 2 days away now, the option is only worth $50. And by the end of the Friday of that particular week, whatever that is, now the option is just pennies. And by Saturday, that the actual expiration date, then it becomes worthless. Here's a question. Can you trade an expiration date? The answer is no. The reason being that the last day of trading is on Friday, the markets are closed on Saturday, and how conveniently they put the expiration date on Saturday. So what happened is that if the option don't get executed because it's completely out of the money, it's too expensive to trade, to buy it back, or it costs you more in commission than what you're gonna get, you let it expire worthless, and those 15, 10 cents, 25 cents that are left in there, that goes to the brokers. So there are millions and millions of dollars every week that remain on the plate that is picked up by the broker. Now, what is delta in an option? The delta in an option is the price that it comes up, that the price that the stock moves based on the actual value of the stock. This is where you find that if the stock went up $2 and you notice that your option, when you look at the delta, it might only go 0.97, telling you that you're going to go up 97 cents per dollar. This is way out of the money. It might be only 0.23. which should be that for every dollar that the stock goes up, you're going to get $23 or 23 cents per share. So this is thing that the option market makers can do to you. The bid and the ask expiration, and what happened at expiration when the option expire on a Saturday. So the game, in a way, is kind of rigged that produce money for the market makers and brokers, and you should be aware of this stuff before you put your dollars into it. Right here is an example of somebody that buys stock, and they say, oh man, I'm gonna buy this stock, it's at $35, but he don't have the $3,500 to buy 100 shares. So he said, well, I can buy an option for 100 shares, and it's at 35, so it's going to be too expensive. But if I buy at the striking price of 40, I can spend $500, and that's what he does. He comes over here and buy $500, pay $500. This is the premium. He paid $500. We know that the premium lose value as time go by. So this is going to be tracked here on the black line. And then on the price that is at 35 right here, we look to our left, this is $35. This is what the price of the stock is. He buy the option on May, and by the middle of June, the stocks start moving up. And here where we get the intrinsic value of the stock. So here we go, and start climbing over 35 and eventually get to $45. So wow. Now the option over here is worth $400 on the premium. So the premium has lost $100, but now I got $5 per share in the money. So when we add the value of the option premium, $400, and it's in the money now. Remember, he bought it at 4. Striking is at 4, and the stock is now at 45. So therefore, now he worth at the 45 is right here, the stock. So the option now worth $900. At this point, you can sell your option and pick up your $400 profit and recover the $500 premium that you made. So here, the option is $5 in the money. It's $500 into it. However, because you already had lost $100 from the premium, you're only going to make $400. That's all you make. You're recovering part of the lost premium through the price of the stock. If you decide and you get greedy and you get emotional about it and say, oh, well, you're going to go higher, and that's not what happened, then the price of the stock gradually start coming back down, and eventually we're going to get down to $45. You know, you're going to remain at $45 at the very end of it. The premium goes right in with behind here, the black line, and the premium eventually at the end of the time that expire in October, you're going to end at 0. So you can see there are two different prices in here and value. The value of the premium that you pay on the option, and the value of the stock that it went up, and it went up $5, and that's what you get at the end. The only thing at the very end is $500. So what happened here that the buyer of the option paid $500 for, so he said, oh, well, I broke even. Well, in reality, you did not broke even for the simple reason that you paid commission at the time that you bought it, and you pay commission at the time that you sell it, and any other federal taxes involved. So you might lose $10, $15. We're going to stop right here for the first part, and then we're going to move to the next part in a few minutes. So for right now, keep that in mind, you know, and remember that this is one way to think about your shares. I mean, when you buy option and shares in stock, who gets what. Thank you for your time, and we'll see you on part 2.